Ever feel like you're just drowning in market noise, trying to find a clear signal? Well, today, we're going to talk about a powerful tool that can cut through all that chaos and bring some serious clarity to your trading. But, and this is a big but, only if you know the one crucial secret to using it right.
Okay, so look at this. On the left, that's what most of us deal with every single day, a standard candlestick chart. It's messy, it's confusing, it's full of signals that seem to contradict each other. But now, look at the right. That's the exact same chart, but with the Heikin Ashi indicator turned on. The difference is, wow, it's night and day, right? A much smoother, much clearer picture of what the market's really trying to do. Now here's the thing. This simple-looking indicator can lead to some absolutely huge winning trades, but there's a critical problem, a fundamental misunderstanding that causes almost everyone to fail with it, and it can lead to some really painful account losses. We're going to make sure you are not one of them.
So, what exactly is this thing that promises to smooth out all the market's rough edges? Let's dive in and take a look at what Heikin Ashi actually is and how it works its magic.
Okay, first thing you have to understand, and this is super important, Heikin Ashi is not a different type of chart. It's an indicator. Think of it like an overlay on your chart. It uses this special kind of averaging formula for its candles, which is what smooths everything out and gives you that much clearer view of the underlying trend.
Let's look at a classic situation. Here on a regular chart, we're in a beautiful uptrend. But you see these random red candles popping up? For so many traders, that just creates doubt and panic. It tricks them into selling their position way too early, and they miss out on the rest of that big move up.
But watch what happens when we apply Heikin Ashi. Boof! Those noisy, scary red candles just vanish. Instead, what you see is this clean, consistent series of green candles. It gives you that visual confidence to just stay in the trade and capture way more of the trend. This right here really shows the core power of the indicator.
But this is where things get a little dangerous. That simplicity can be really deceptive, and there is one single mistake that can lead to some really painful losses if you're not aware of it.
So what is that number one mistake? What is the trap that so many traders fall into? Well, it all comes down to understanding the fundamental difference between what you're seeing with Heikin Ashi and what the actual market price is doing.
The mistake is treating the Heikin Ashi candles as the real price, but they are not. Just look at this comparison. On the left, Heikin Ashi is showing this huge, powerful green candle, suggesting super strong momentum. But on the right, that's the actual price candle for that exact same period. It's tiny. The price barely moved at all. This is exactly why you cannot trust it for the exact price.
I'm going to say this again because it is just that important. Heikin Ashi is an indicator of trend and momentum. It is not the real price. You must always analyze your key price levels, like your support and resistance, on the real candlestick chart.
Okay, so with that huge warning out of the way, let's learn the simple language of Heikin Ashi. It all comes down to understanding its three basic candle types.
First up, we've got the bullish candle. It's green, and the key feature you're looking for is a long upper wick with little to absolutely no lower wick. This is your signal for upward momentum. The bigger that green body, the stronger the uptrend is. A whole series of these with no lower wicks is an incredibly powerful signal.
And the exact opposite, of course, is our bearish candle. It's red with a long lower wick and little to no upper wick. This tells us the price is in a downtrend. And just like before, a large red body means you're in a very strong downward move.
And finally, we have the doji. Now this one can be green or red, but the real key is its tiny little body and wicks on both the top and the bottom. This candle is basically screaming indecision. Neither the buyers nor the sellers are in control, and it's often a huge warning that a trend is getting weak or maybe even about to reverse.
All right, now based on those three simple building blocks, we can identify 5 really powerful market signals. Understanding this market story is absolutely crucial for building our trading strategy.
Let's just run through these real quick. A strong uptrend, that's a series of green candles with no lower wicks. That's your signal to just hold that buy trade. When those green bodies start to shrink and lower wicks appear, well, the uptrend is getting weak and it's time to prepare to exit. Multiple dojis in a row, that signals a sideways, choppy market with no clear direction. On the flip side, a strong downtrend is a series of red candles with no upper wicks. Hold your sell position, and finally, when the red bodies shrink and upper wicks start to appear, that downtrend is losing steam and you should get ready to close that sell trade.
All right, it's time to put it all together.
Let's combine this knowledge of candles and signals into a simple but really effective trading strategy.
This is the 4-step key level strategy. Step 1, and this is the most critical part, is to find a key level, like support or resistance, on the real price chart. Step 2 is all about patience. You just wait for the price to come back to that level. Step 3 is our confirmation. We watch the Heikin Ashi candles for signs of a momentum shift. And only then do we move to step 4, which is entering the trade.
Let's walk through an example. So, the real price is approaching a strong support level. We're thinking about maybe buying, but we look at the Heikin Ashi chart and it's just showing big, angry red candles, a strong downtrend. So what do? We do nothing, we wait. Then we see the red bodies start to shrink, maybe some upper wicks appear, and finally, a candle turns green. That is our confirmation. The downward momentum is gone. Now we have a high probability entry signal.
And hey, here's a pro tip to really maximize your winning trades. When your trade hits its initial profit target, don't close out the whole thing. Instead, close out maybe 50 to 80% of it to secure your profit, and then let the rest of the position run. You use the Heikin Ashi signals, waiting for those shrinking bodies and opposite-colored candles to tell you when the trend is finally over. This simple trick can help you capture some much bigger moves.
Look, at the end of the day, Heikin Ashi isn't some magic bullet, but it is an incredible tool for filtering out all that market noise and confirming momentum. When you combine it with solid analysis on the real price chart, you can bring a powerful new layer of clarity to your trading. So the real question is, how will this smoother view of the market change the way you make your decisions?